Wednesday, right? So there's really not much time left for us to mess around. So I'm going to go ahead and get us into chapter 10, okay? And, 11, excuse me, chapter 11, sorry. And I forgot to start the recording. No, we're recording. Okay, hello. Okay, so let's go ahead and get ourselves into chapter 11. Okay, hang on, guys. Sorry. It's always something with this. Close that. Try it again. Are we really responsible to know how to do the journal entries for both the investor and the borrower? Not the investor. We're dealing with the borrower's accounting. Okay. You can ignore that investor stuff. It was just sort of there as a reference, and if we had had time, I would have gone into it. But yeah, you'll learn that in intermediate. Okay, guys, sorry about that. So let's go ahead and let's get started. Chapter 11, and we're going to be talking about issuing now stocks, and so we're assuming that we're dealing with a corporation. Okay, advantages of corporation we talked about. I think it's one of the first chapters. Separate legal entity. Limited liability. If there's some sort of problem with the company and the company goes under, you may lose your investment in the stock, but they're not going to come and sue you and take your house, etc. Right? Okay. Now, some of the disadvantages: increased government regulation. If you're a corporation, you will be regulated by the state because you are incorporated under the state laws, but you will also have what? Federal regulation coming down on you as well through the SEC, Security Exchange Commission. Remember, they oversee the financial reporting for corporations, okay? Additional taxes. We call this double taxation. What happens? Corporations are seen as a separate legal entity for tax purposes. So not only does the corporation pay tax, but then when there's distribution of dividends to the shareholders pay a certain amount of tax on that as well. So they consider that a double taxation issue. And then corporate management. There is the separation between the management and the ownership. If you hold a share of stock in Chevron, can you go in and march in and say, hey, this is what you should do today? No, you're almost as in much as control of that as you are when you're watching the baseball game. And you say, hey, Bochy, don't change that pitcher. He goes ahead and changes them anyway, right? Okay? Or whatever. Okay? So it's a separation between management and ownership. Okay? So you take a look as another disadvantage. So you take a look at these disadvantages, again, the different levels of regulation, both state and federal. Stock exchanges, etc., the double taxation issue, and then the separation of ownership and management. So those slides are a little behind my comments now, right? Okay, all right, so when we're sitting here and we're looking at the structure of a corporation, you have the stockholders. Stockholders will elect and have the right to vote for chairman, board of directors, etc. The board of directors will appoint the chief executive officer, and then we have these various individuals that fall under that. And I would imagine that most of you are going to be right here, right here, right? Okay, but there are these other positions that you'll hold prior to that, which are going to include financial, and we're just focusing on the financial positions here, the treasurer, the controller, okay? But you should be shooting up here. I mean, you don't come out of UC Berkeley and expect, geez, hopefully someday, and I'll have students tell me, someday I want to be a controller. Well, I'm like, well, let's shoot a little higher, right? You can get at some of these higher levels. Although there's nothing wrong with being a controller, but, okay? All right, good. So you come over, and when we form a corporation, it is under state charter, okay? Now, a lot of corporations these days, not these days, but for a long time now, will incorporate in states like Delaware. Okay, Delaware is famous for having less stringent corporate regulations, etc. So you see a lot of states that say, why are so many, a lot of corporations why are so many corporations incorporated in Delaware? They tend to be a little easier, okay? California, is it easy or hard? Hard. New York? Hard, right? Okay, so the bigger states tend to be a little more intense. Okay, all right, good. Now, when we talk about stockholders, and the common stock is what we're really talking about here. Common stock carries with it the right to vote. It carries with it typically the right to receive some sort of dividend when those dividends are actually declared for our common stockholders. Okay? All right, good. Now you come over, and I think I've talked about this last time. If we go out of business and there's a money bag missing here, who gets the first money bag? The CPA, the CPAs, attorneys come first because they're the ones that have to figure out who's getting these bags of money, right? So nothing happens without CPAs, without attorneys. Then come taxes, then come probably employees, that sort of thing, right? We've got to pay wages. Then start to come in our secured lenders, like whoever gives the mortgage on the building. Then unsecured lenders, and if there's anything left, who comes? The stockholders. So stockholders are way down the residual claim line here. Okay. All right, good. Stock certificate, whatever. Who cares? They don't really print them like this anymore. Although I used to tell my students, you'll never see a stock certificate again, especially my CPA students. And then they said, psst, John, come here. I've actually seen them because I have a client who holds foreign stocks, and a lot of foreign corporations will still represent their ownership this way. And I said, oh, okay. I've only been dealing with gigantic organizations like public debt entities, that sort of thing, that they sit there and they have this all on book entry now. Okay. Okay, so when we talk about our stock, we have shares authorized, issued, and outstanding. The shares authorized is what it's in our articles of incorporation that say the total number of shares we would be able to issue at any point in time. And so the shares authorized could be, say, and I'm just going to make a number here, authorized might be 100,000. Okay, shares authorized, say 100,000. We have to report that in the stockholders' equity section of our balance sheet. So we'll literally put in parentheses, common stock authorized 100,000 shares. Okay. Now the market value of the stock, let me make sure I just put everything here. We have shares authorized. We'd also have the shares issued. Okay. So let's say this entity issued 80,000 shares. Do you have to issue every single share that you're authorized? Okay, so they're only issued 80,000 shares. Now let's say that this entity went out, this corporation went out on the market and reacquired their own stock on the open market. Can they do that? As long as they have cash, they can reacquire their own stock. That stock would be called treasury stock. And so let's say the treasury stock was 10,000. Well, we have issued 80. The treasury stock is 10,000. Then the number of shares outstanding would said to be what? 70,000 shares? 70,000? Because what? 10,000 of those are no longer outstanding because we've reacquired them in the open market, haven't we? Okay, and so we have what? We have the shares authorized, issued, and then if we have any treasury stock, that's backed off of the shares issued, and the difference is going to be the amount what? Outstanding. Okay, authorized, issued, take off the treasury stock, and gives you the outstanding. Okay, good. Now, when we talk about the market value of the stock, as you well know, Paul?
How do you calculate outstanding again? Just multiply it, or subtract issued from treasury?
Well, I would subtract treasury from issued, but yes.
Okay.
Yes, take the issued, subtract the treasury stock, they give you the outstanding. The treasury stock is the number of shares that they've reacquired in the market, and so it makes sense. Outstanding, those 10,000 are no longer outstanding because we reacquired them, right?
Okay. Yeah.
Okay. Okay, good. Yes, sir.
If the company sold more stocks, would it come out of treasury or authorized?
If they sold more, I really don't know. I would imagine that they would sell their treasury stock before they'd sell amounts that haven't been issued, but I don't know for sure if there is a order considered appropriate for issuing additional stock if you issue it out of treasury or not. But if they did issue 2,000 and they issued out of treasury, treasury would come down 2,000, and the amount outstanding would go to what? 72,000. Okay, I'm not sure, Peter, what the order is and how they reach into which bag to sell next. Most of the problems that I see, they start selling this treasury stock off. Okay, we're not going to get into treasury stock in here. We are simply going to make you understand that in your stockholders' equity section, you have to show the number of shares authorized, issued, and outstanding. Okay, and the difference between issued and outstanding is the treasury stock.
So even though, like, if you haven't issued 20,000 in this case, does that mean that like the company has those 20,000 stocks, so they just like they can't issue them at a later time?
They can issue them, yes. They're limited to 100,000, and frankly, they could probably get authorized for more. I mean, it's not like they get handcuffed to 100,000. You might have a corporation like Kodak or something that thought they were going to be a small company and ended up being this huge company, right? So I'm sure you could probably go back to the state and get authorized for some more. Okay, now market value of stock, I'm sure you well know, is what it trades on the various exchanges, right? New York Stock Exchange, NASDAQ, etc. Okay? There are foreign stock exchanges, the Shanghai Exchange, and I put this picture of me in Shanghai talking to a group that wanted to take the US CPA exam and talking about the CPA exam taken in China. And the only reason I left this picture in here is so you can see that they are also just as interested in what I say as you are. Can you see that, right? Okay. All right. So you can take the US CPA exam overseas now. But the main point of this slide is what? Is that there's stock exchanges all over the world. It's not just the New York Stock Exchange, right? Okay. All right, now we take a look and we have this listing here, and this is Nike, and Nike in the last 52 weeks had a high of 78.55, a low of 48.76. This is their volume for the day, this is their high for the day, this is their low for the day, and this is their close, and then the net change is the difference between what they opened on that day and what they closed on that day. Okay. All right, good. Enough of all that. Let's start to get into the accounting, right? All right, so when we start dealing with the accounting, we need to understand stock as being par and no par valued stock, okay? Par and no par. Now, if you have no par stock, it's going to call out a par. No par stock will not have a par, you think, but sometimes they will have a stated value, and the stated value will take the place of the par value. And then sometimes you have stock that has no par and no stated value, and we're going to see the difference in accounting between these, okay? Now, if there was such things as a who gives a you-know-what channel, this would be playing on it all day, okay? Who cares? But we need to understand this a little bit. It's very annoying, okay? So what happens? We sit here, and you've known for a while now that we've had our common stock and our retained earnings being our capital not our capital structure, but our equity, right? Our stockholders' equity. All we're doing now is we're adding that we could have preferred stock, and then if we pay amounts in excess of par, we will deposit that in an account called paid-in capital in excess of par. It is the world's longest title to an account and the most descriptive. What goes into that account? Well, the paid-in capital in excess of par. Okay, so anything that gets paid in excess of par goes there. Okay, so, and of course we have our retained earnings, as we've mentioned for a long time now, as part of our stockholders' equity. Okay, so let's just look at this, and then you're going to go, that's it? Really? That's all there is to this? Okay, so we have what? We have our $1 par common stock, and we issued 2,000 shares. The first 1,000 shares are issued at par. And then what? We issue an additional 1,000 shares with the dollar par value, but we issue these for $5 per share, right? Where does this $5 per share come from? I mean, I know the problem gave it to us, but theoretically, where is that coming from? That's the market, right? The market is determining what this company can sell their stock for, right? So if you sell it at par, then there is no additional paid-in capital in excess of par because you sold the stock at par. So you take the number of shares, multiply that by the price per share, which was the par value. The entire credit goes to common stock, right? If you issue it for more than par, then of course you're going to get more cash. And this time they issued it for $5 times the remaining 1,000 shares. That was cash getting debited for 1,000. We still credit the common stock up to the par. What's the difference between 5 and 1? 4 for 1,000 shares. That goes into the account name with the longest name in the world and also the most descriptive, which is additional paid-in capital in excess of par. Isn't that exactly what it is? If you're waiting for deeper meaning, stop. We just take what? The extra and put it in that account. Samantha?
So even though you paid more, it's still worth the $1 per share?
We were paid more for it.
Yeah, so if I bought it for $5, it's still only worth $1 per share?
Well, its par value is $1. It's worth $5 per share.
Okay.
In addition, the difference between the 1 and the 5 is the $4 that's going into additional paid-in capital in excess
So
of
it's
par.
still worth more, but then you just write it originally. It's on par.
The amount that goes into common stock is capped at the par value, and the difference goes into additional paid-in capital in excess of par. Theoretically, this stock is worth $5 a share. Okay? Okay, good. Now you come over, and when we look at our stockholders' equity section now, and this is what it would look like after these transactions, our common stock is 2,000. That was the 1,000 for the first round of shares. It was 1,000 shares that we issued at $1, and then the second 1,000 also got issued into common stock for $1, and then since we sold those for $5, we put the extra $4 per share into our additional paid-in capital in excess of par, right? Hello? Come on, guys. We had two issues. We issued 1,000 shares for $1. We debited cash, we credited common stock for $1,000, didn't we?
Yes.
Everyone with me?
Yes.
Yes.
Then we went ahead and we issued another 1,000 shares. Those were $1 each. So we credited common stock for 1,000, and in this class, we abbreviate additional paid-in capital in excess of par, APIC. And so we went ahead and we credited the APIC for 4,000, didn't we? On that second entry? Did we credit the APIC for 4,000 on the second entry?
Yes.
Okay. The easiest part of preparing a set of financial statements is to just pull the numbers out of the ledger, right? How much is in common stock? 2,000. How much is an additional paid-in capital in excess of par? 4,000. Okay. All right. So we come over, and of course we'd have our retained earnings, whatever that was, because that's part of our capital. So all we've done, or part of our stockholders' equity, all we've done is we've added the additional paid-in capital account, haven't we, to our stockholders' equity? Okay. Okay. Good. Now we come over, and what if it is no par stock, but it has a stated value of $5? Well, now the term stated value takes over for the term par. Okay, I'm telling you, they could play this all day long on the Who Cares channel, right? And sell advertising on it, okay? Because it's so clear to the meaning of who cares, okay? So if it is what? If it is $5 stated value and we sold it for $8 per share, well, we'll go ahead and if it was 5,000 shares, 5,000 times 5 is 25,000. That goes to common stock. 8 minus 5 is $3 per share times the 5,000 shares. The difference goes into what? Additional paid-in capital in excess of par. Huh? Or in excess of stated value. Okay? Who cares? All right? Okay, now you come over and you're saying, well, why are you teaching it to us then? Because I don't want you out there not knowing when they give you a problem on the CPA exam and ask you something stupid like this that you don't know the answer. But this to me is dumb. If it's no par stock, if they don't give us a par, they don't give us a stated value, everything goes to common stock. Okay? Question? Okay, good. Now, there are dividends that we've talked about. And in this class, we've been talking about cash dividends. Whether you realize it or not, we just debited the word dividend, didn't we? And when we debited the word dividend, we credited cash. So all of our dividends up until this time have been cash. A company could distribute dividends in something other than cash. I don't know. Apple could distribute dividends by distributing iPhones. Would they do that? No, because they like, no. We can sell iPhone for money. We're not going to distribute it as a dividend, right? But I don't know. Let's say they had a bunch of those. They probably would save those. You guys don't remember. You know that Apple was like on the brink of going out, right? I mean, they were going to go under, and they started selling these like different bright plastic colored computers, like orange ones and blue ones and green ones and stuff. So let's say they had a bunch of those left over and they said, well, let's get rid of this junk. They might distribute that as a dividend, a property dividend. If that's the case, they would debit the property dividend and credit the debit the dividend and credit what? Credit the inventory as they distribute that item as inventory instead of cash. Okay, so we have these different dividends. Now, important dates for dividends. You have the declaration date for a dividend. That's the day that the entity declares the dividend. At that point, we'll make a journal entry saying what our dividend amount is and saying that we have a dividend payable, because we're not going to immediately pay it out in cash. We're going to pay it in a little while. Okay, that is the date of declaration. Then we have the record date. The record date is the date that we note who holds that stock, and that dividend will be paid to that individual regardless of who holds the stock on our payment date. Okay, so what happens? I'm holding a share of stock, and they declare a dividend on December 1st. I go ahead and I sell that stock to Carl. When I sell that stock to Carl then, and that's before the 22nd, who will they pay the dividend to? They'll pay the dividend to Carl. Let's say I hold that stock on December 1st when they declare the dividend. I still hold it on the 22nd, and then I sell it to Carl on the 21st, on the 24th. Who are they going to sell that dividend to? Who are they going to pay that dividend to? Now they'll pay it to me, right? So they fix whoever holds the stock at a given date. That's called the date of record, and there is no accounting entry associated with that. It's just noting who holds the stock. And then we go ahead and pay a little bit later, and when we pay the dividend, of course, we will debit the dividend payable, and we will credit the cash at that time. Okay, so let's go ahead and let's take a look. Cash dividends. It's declared by board of directors. Dividends are determined by board of directors. That's why we have them. They'll decide when a dividend is to be paid. Okay, so on the date of record, we will debit cash dividend. And the reason we're calling out cash dividend now, guys, instead of just dividends, because you're a little more sophisticated and you now know that dividends can be something other than just cash, right? So we go ahead and we debit the cash dividend. We credit now, instead of cash, we credit dividend payable because we're going to pay it at a later date, right? Date of record, no entry in the accounting records anyway. They're simply doing what? They're simply determining who holds the stock on that date, because that's who they're going to pay it to on January 20th. It doesn't matter if you sell it after that or not. They're going to pay you that dividend on January 20th. And when they finally cut to January 20th, they go ahead, they debit the dividend payable. They credit the cash. They're paying the dividend now, right? Okay. Okay, good. Stock splits. What happens here? Let's say our stock is selling for $100 a share. Is that expensive? Might be. You want to buy 100 shares, you're going to have to cough up what? $1,000? No, $10,000. You may not have 10,000. You may sit there and say, gee, I'd like to buy more shares, but that's too rich for my blood. I can't afford all that. I don't have all that. Okay? And so if anybody in here a marketing person? Huh? No marketing folks? Okay. A marketing person, if you wanted to sell more shares of stock, what would you do? Lower the price. There's our marketing genius, right? And so what happens? You're going to go ahead, Veronica, and you're going to do what? You're going to lower the price. So how about if we half the price? We'll make the price half, okay? So we're going to make the shares now worth what? $50 per share. Do you think people might buy more now? Okay? So when we have a stock split, here's what we do. We cut the price, and it's usually a 2-for-1 split that we'll talk about in this class. You could have other ratios, but here, just to make it simple, we'll talk 2-for-1 split. You would do what? You would have the price, and then you would double the number of shares that are outstanding, okay? And so what happens? If it was $100 per share, and we had 10,000 shares outstanding, that would mean our common stock is... Guys, you know I'm not good with numbers. What is it? 100 times 10,000? Huh? So we would have our common stock would be 1 million, right? Right? Okay. What we do when we have a stock split is we just say the shares are $50 per share. And now, instead of only having 10,000 shares, we have how many? 20,000. What's our common stock? $1 million. So our common stock doesn't change. We have simply done what? Doubled the number of shares, but halved the price. And sometimes stockholders will go, oh boy, we got a 2-for-1 stock split. We've got double the amount of shares that we had before. Meanwhile, what? The stock has gone half in price, hasn't it? Okay, so they've got no more value than they had before or after the stock split. So what happens? If that's the case, and you look at our before and after the split now, same thing that I was doing up here, we have what? We still have our $500,000 of common stock. Instead of having 50,000 shares, we now have 100,000 shares, but instead of the price being $10, it is now what? $5.
Could you go back 2 slides real quick? Right, for the January 20th, are you crediting cash or crediting cash dividends?
I'm crediting cash, and I am debiting the dividend payable. Cash dividend is going to be reported on my statement of retained earnings, right? Before we just called it dividend, now we're calling it cash dividend. So my statement of retained earnings will show a subtract from my retained earnings for my dividends, right? And then do I turn my dividends back to 0 at the end of the year?
Yeah.
So at the end of the year, I'll go ahead and I will debit my retained earnings. I'll credit my cash dividend to close that account, right?
Yeah.
So all we've done is put the word cash on what was dividends back in Chapter 1, just because now you understand that not all dividends are cash. Some dividends could be property.
So why don't you credit cash dividends instead of cash?
Because I will credit cash dividend just like I credited dividend in Chapter 1 to close it at the end of the year. And it's reported on the statement of retained earnings. It's to subtract from my retained earnings.
Like on the case they have on the board, if you wanted to do a stock split, could you like not, because you're only authorized 100,000, so like, does it work that you double like the
I don't know, guys. I'm not a stock, agent. I don't know. You may be able to. I don't know what the rules are. They're probably different every state. I have no idea. Yeah, I don't know. And it could be different from state to state. Probably you'd have to tell the state something before you go and just do a stock split, but I don't know the legal process for that, the administrative process for that. Okay? Okay, good. Now you come over and we take a look and notice here, guys, that what? The common stock account stays the same, doesn't it? The total of the common stock. And if account stays the same, do we need to make a journal entry to it? No, journal entries are designed to make changes in the amounts in the accounts. And since there has been no change in the amount in the accounts, we've simply doubled the number of shares and halved the price. The big takeaway here is that for a stock split, what? There is no journal entry. No journal entry. Okay? Okay, good. And there's our statement of stockholders' equity. And I guess this gets a little confusing because to be consistent, they should have called this cash dividends, but again, we're being dramatic here by calling them cash dividends just to distinguish them from the potential of what for a property dividend. Okay? Yes, sir.
Going back to the journal entry of cash dividends, we're supposed to close out cash dividends, so we credit that, and that goes into the
Debit retained earnings. That's correct. We would debit retained earnings, we'd credit cash dividend to close it at the end of the year. Just like in Chapter 1, we debited retained earnings and credited the account dividend to close the dividends, and they were known to be cash dividends. The only reason we put the word cash on here is because now you're sophisticated enough to understand that there's something other than cash dividend. So if it was property dividend, it would say property dividend on there, but it would still work the same. Instead of crediting cash, of course, when you pay it, you would credit land or whatever it is you're issuing as the dividend, or inventory or whatever. Okay? Okay, good. And there's our statement of stockholders' equity. And let's take a look at this one now, because sometimes we can issue common stock, and instead of people giving us cash, they can provide us a service. So when you guys go ahead and you jump on that entrepreneurial train that you were talking to me about in the first class, you're going to probably have to pay some legal fees and that kind of stuff, and you're going to look around and you're not going to have any cash. And you're going to say to the guy, will you take stock in exchange for the legal services, whatever that you just provided me? Do you think the guy will take it?
No.
No.
Why?
That's not working.
Why? You don't have, oh ye of little faith. I mean, the guy may look at your business and say, you got it, man. You got it. I think it was, I forget who the guy was, which guy it was. It was somebody like, maybe it was Bing, you guys heard of Bing Crosby, right?
Yeah.
He was like this singer in the 40s, I'm dreaming of a white Christmas and all that kind of stuff, right? And so he did some work for Disney, and the way he asked to be paid was not in terms of cash. He asked, and it's not really relevant to this example, but he asked to have the rights for all the film that was sold at the stores in Disney. Do you think he made a pretty shrewd move there? Okay, so, that'll happen when companies are getting off the ground. People will go ahead and do what? Get their little investment in early, right? And they're thinking, hey, this thing's going to grow. So it could be very well that the person will say, you know what? I like this idea. Chocolate coffee, man. I've been waiting for that, right? And so what happens? They'll say, just give me some stock. That'll work, right? And so what happens? If the guy charged me $5,000 for the service, and they're willing to take what? Stock. The stock's par value is a dollar per share. It's 4,000 shares. Do we have an amount paid in capital in excess of par? Yes. Let me just show you the journal entry, and you'll go, oh, I see. Okay, so it's what? It's the $4 par that goes into common stock, and the fact that we got something of value, that service, that's more than the par, that additional amount goes to additional paid in capital in excess of par, right? Do you ever, this is beyond the scope of the class and the exam, do you think we should ever capitalize, treat as an asset startup cost?
Yes.
Who said yeah? You want to capitalize startup costs? Why? Who told you to do that? Who told you to put a bomb on?
To get the benefits of the amortization. Or
You're going to have to Google some of these references. That's a Seinfeld reference, whatever. Who told you to capitalize?
to get the benefit later on when the company actually starts making money, so they get the deduction
When the company doesn't make money? No, deduction to what?
to the income. So
Huh?
if-
Don't talk to me about taxes. This is not a tax class.
Okay, never mind then.
We're talking about accounting, okay? Remember when we had what? When we had our research and development, we expensed it because most research and development crashes. So also do most what? Most startup companies eventually go downhill, don't they? Okay? And so what happens? A lot of them do. So what happens? FASB says organizational costs are immediately expensed. You can't sit there and capitalize organization expenses. Violation of the generally accepted accounting principles. You expense everything. Go ahead. You have a counter to that? Huh? No? Okay. Okay. You look like you were thinking no, because I read something somewhere else that said something different than that. No? Okay. Okay. All right. So you come over and you would debit organizational expenses. Okay, good. Let's say they give us land in exchange for the stock. Okay. So now what's going to happen? Well, in this example, they tell me that my shares are actively traded at $8 per share, and they tell me that it's 10,000 shares of stock that I'm issuing. So the problem, you have to look at it carefully, and you have to see which item has the more determinable value, and that's what you use. Now they're telling me that what? The land was recently advertised for sale at 90,000. Is that reliable? No, that's not reliable. I mean, I could sit in my house and say, for sale, $5 million. And I can promise you no one's going to come and pay $5 million for it, right? But I can advertise it for that, can't I? Okay. So the more determinable value here is the actively traded stock at $8. So we use the stock, right? Now you'll see some problems when you do the homework. They won't tell you the market value of the stock. They'll only tell you the value of the land. And in that case, you're going to have to use what? The value of the land. So you have to read the problem to see which one gives you a more reliable value. That's what you use to drive the transaction. Since it was the stock and it was $8 per share actively traded, and we issued 10,000 shares, then the land comes in at 80,000. The par value of the stock was what? $5 times the 10,000 shares. That's 50,000 to common stock. Difference goes to additional paid in capital, right? Okay. What if they said they didn't? Go ahead, Paul.
So like you don't really need to know what the land was being sold at.
What it was advertised for? No. But what if they told me, let's say they didn't tell me this, and they told me that the land was appraised, let's say, instead of advertised, it was appraised at 90,000. Now what are you going to do? Well, now that 90,000 is more reliable, isn't it? Is what I was trying to do. So the land will come in at what? 90,000. If it was still 10,000 shares at $5, that stays the same. This obviously now goes up to what? 40,000. So you've got to read the problem carefully to see what it is they're telling you has the more determinable value. And in this case, it was the stock because they used the phrase, it was actively traded, right? Okay. Okay, good. Now you come over and you take a look at preferred stock. Accounting for preferred stock. Now, preferred stock, you say, well, why is it preferred? It has priority often in terms of dividends. Dividends are typically paid to the preferred stock before they are going to be paid to the common stock. And then if there is a liquidation, the preferred stockholders get in front of the common stockholders. Okay. The bad part about the preferred stock is there's generally no voting rights with it. Okay. So we come over and we take a look, and when we issue the preferred stock, and they issue it for $12 per share, and if that's the par value is what? 10,000. And so it's just like we saw for the common stock, the number of shares times the par value, that goes to the preferred stock. Difference goes into paid-in capital in excess of par, right? Our APIC. Okay. Okay, good. Now you come over and we talk about dividends. Okay. And this lady is smiling because she has what? She has going to have the current year dividends and dividends in arrears. Okay, so what happens? The preferred stock will receive dividends before the common stock. Per share dividend amount is stated as a percentage of the preferred stock's par value. If you have a cumulative dividend, that means that preferred stockholders will have to be paid both the dividend in arrears, previous year's dividends, plus the current year dividend before the common stockholders can receive any dividend. Okay, so when it's cumulative, it's going to build up for them, and they'll be able to receive those in arrears dividend, and then they get the current year dividend. Okay, so let's just use a numeric example. Okay, so we have 5,000 shares of 7%, $100 par value cumulative preferred stock. Each $100 share pays a $7 dividend. They got that by taking the what? 0.07 times the par value. Okay, so it's $7 dividend per share. The annual dividend is $35,000, which is 5,000 shares times the $7. If dividends are 2 years in arrear, preferred stock are entitled to receive the following dividends. Dividends in arrear is going to be what? The 2 years in which it was $35,000. Now, at this point, the board of directors maybe even hasn't declared a dividend. The dividends accumulate because it was what? 7%, $100 stock, $35,000 a year. If you have what? 5,000 shares, $35,000 year one, $35,000 year two, right? Then what? Then the current year dividends are $35,000. And so now we owe the preferred shareholders what? $105,000, and if the board of directors declared the dividend here in this current year, we would have to first pay out our preferred dividend holders what? $105,000, the $35,000 from year one, $35,000 for year two that have accumulated, plus the current year before our common shareholders get anything. Which one do you want? Do you want the preferred stock or the common stock? Preferred sounds better, but don't forget they don't vote, right? Okay, so there's a price associated with this. Peter?
Does this have anything to do, it has only to do with the declaration at top, whether the company is able to or not to pay.
Companies can declare dividends regardless, although notice I point out to you that it's kind of stupid when we had companies having losses in Chapter 1 and they were still paying dividends. So typically dividends are paid out after the company has had a series of very profitable years, and now they're trying to distribute dividends to the shareholders. And if it's a cumulative dividend, that will continue to accumulate until it is what? Until it is declared. Okay? Okay, good. So let's go ahead and see how we would allocate. And we say the holders of cumulative preferred stock must be paid any unpaid prior year dividends and the current year dividend before common stockholders receive dividends. Okay, so on December 31st, 2015, IBR Inc. has 1,000 shares, 8%, $100 par value common stock, preferred stock, cumulative preferred stock. It also has 50,000 shares of $10 par value common stock outstanding. At December 31st, 2015, the directors declare a $6,000 cash dividend, prepare the entry to record the declaration of the dividend. Okay, so we're going to debit cash dividends. We're going to credit dividend payable. Okay, Now, how much goes to which ones? Well, notice that we had the 6,000 dividends declared, and we're going to allocate 6,000 to our preferred shareholders. And then we have in year 2 now, we have 50,000 that has been that is going to be paid out and declared and paid out. So what happens? We go ahead and we're going to have to first take 2,000 that will be the dividends in arrear that will go to the preferred shareholders, because remember, there were what? They were 8% times the 100, so that's what? $8 per share times 1,000 shares. So they really had what? 8,000 coming that year, right? Even though they only declared 6. So they got 6 in that first year, but those amounts in arrears roll over to that next year, even if it's not declared, right? Okay, so first we catch them up their 2,000. That was the 8,000 dividend that they were supposed to get minus the amounts that were declared. So we give them that 2,000. Then what? Then they get their 8,000 for this year, right? And remember, the 8,000 is what? The $100 times the 8% times 1,000 shares. So that's 8,000 for the current year, isn't it? Okay. So now we've paid them what? We've got to paid them $16,000, right? The 2 plus the 6 plus the 2 plus the 8, 16,000 is going to go to the preferred shareholders. And then what? The remainder is going to go to the common shareholders now, which is going to be the 40,000 for the current year. Okay, that's out of this 50,000 for the current year. They're asking for the current year 50,000, 2 from last year, 8 from this year, 40,000, and the preferred shareholders will get a total of 16,000. Okay. All right. Liquidation preferences. Preferred stocks have preference, and we've already said that. All right. Question. All right, good. Let's go ahead then, and let's jump ourselves.
What are they going for? What are the
APIC is part of our stockholders' equity. So our stockholders' equity prior to discussing APIC was common stock and our retained earnings, and now we're just picking up the APIC as part of that. Stockholders' equity. Alyssa.
Do you have one APIC account, or do you have one for R and one for?
One APIC account right now. There could be other APICs for other things, but that's beyond the scope of this course. Okay. All right, good. So let's go ahead and let's discard that. And let's take a look at Chapter 11 quiz. And guys, this is back to, Chapter 1, 2, whatever. We're sitting here and they're asking us the ending balance and retained earnings. And retained earnings is the beginning balance plus our net income minus any dividends, right? Hello? Okay. All right, good. You come over and we say Comfort Mattresses sold 26,000 shares of $1 par value common stock at a cash price of $12 per share. The entry for this is going to be 26,000 times 12 is the cash, right? Right? The 1 times the 12,000 is the 26,000 is going to be the credit to common stock, right? And the difference goes to additional paid-in capital in excess of par.
Yes.
Okay. Number 5. A corporation issued 6,000 shares of $2 par value common stock in exchange for land that had a market value of $84,000. Now this is what? This is the opposite of what we saw in the problem. In the problem, the stock had the more determinable value, didn't it? Now they're just giving me the value of the land, so I got to roll with this, right? And apparently this land had a more determinable value.
What is that?
Huh?
More determinable value.
More reliable value than the stock did, for whatever reason.
So how can you tell after the question?
Well, tell me how I would determine the value of the stock here.
I would think like 6,000 times 2. Is that right?
That's the par value, but they're not giving me any information about what the stock is selling for, but they're giving me the market value of the land, aren't they?
So issued means that they just like make it, they don't sell it. Right?
They issued the stock, but they don't give me the market value for the stock. So I can't come up with a market value for the stock, but they give me a market value for the land, don't they?
Yeah.
Okay. So since in the other problem, they said it was being actively traded on the market, so they gave me the market value for the stock there, didn't I? That's why I'm saying you need to read the question to see which one they're giving you the market value for, right? Which here is clearly the land. So we would debit the land for $84,000, credit the common stock, and it's what, $2 a share, 6,000 shares? Credit the common stock for $12,000, and so the A pick now is going to be the answer to this question. It's going to be credited for the difference, right? So the land drove what the value was that was associated with this transaction. And the other problem was the stock. And again, you have to read the question. If the stock is being traded on the stock exchanges, then it has the best value, doesn't it? It's being traded every day, and people are, it's being listed and it's traded every day. But maybe this is a company that, it's just some guy that just got off the truck from Sacramento who just got done incorporating and says, I want some land, let me issue some stock. And so now the land is giving it more determinable value, doesn't it? Who knows what the market value of the guy's stock is at that point? So the land drives it. So whenever one has a more reliable, more determinable fair value, that's what you use.
You wouldn't put something like land would be the market value of the land and the publicly traded stock.
No. No. We'll make it clear which one has the better value. Yeah. No, I'm not going to make you flip a coin over, make you guess. Okay. The fact that, and typically, Carl, the issue is that they don't tell you what the value is of one of them, which is what you see here. Now, in that other one, they said it's advertised. Like I said, advertised. So what? I could advertise a piece of land for anything. That doesn't mean someone's going to buy it for that, right? Okay. All right, so let's come over and let's take a look at number 6. A company issues 60,000 shares, $100 par value common stock for $7,000 cash. The journal entry, debit the cash $7,000, credit the common stock for the dollar times the what? $100, I should say, times the 60 shares. That's $6,000. The difference goes to paid in capital in excess of par. Huh? A company's board of directors votes to declare a cash dividend of 75 cents per share. The company has 15,000 shares authorized, 100,000 shares issued, and 9,500 shares outstanding. And I didn't mention that. Dividends are paid on the shares outstanding. Dividends are paid on the shares outstanding. Dividends are paid on the shares outstanding. Okay, good. Number 8, a company's board of directors votes to declare a cash dividend of $1 per share on 12,000 common shares outstanding. The journal entry to record the declaration of the cash dividend. Okay, this problem is annoying because these people credit the common dividend payable, which I'm okay with that. But they should have debited what? They should have debited dividends. This flies in the face of what we've learned, in that what? We debit dividend and then we close dividend and retain earnings, don't we? And when we close dividend and retain earning, we debit the retain earning and we credit the dividend. These guys got lazy and they just jumped straight to what? The retain earnings account. I mean, net, it's not going to make much of a difference, but theoretically, procedurally, when we prepare our financial statements, we go income statement, then statement of retained earnings, don't we? And we would need to see what the dividend amount was to report that on the statement of retained earnings. Then we can go ahead, do all our closing entries, and we would close out our dividend and retained earning, and then we'd be able to prepare our balance sheet, right? So this is not the best question, because they should have gone to dividends. However, if you somehow ran into a question like this, and this was your choices, clearly retained earnings is the only correct choice here, right? For the declaration. Is there any such thing as dividend expense?
No.
Okay, so A and B are gone. Is there any such thing? Well, why would you debit the dividend payable? If you're declaring the dividend, you're going to credit the dividend payable, aren't you? Okay. And so that takes C and D out of the mix. But they should have been more careful and had you debit dividend. Okay, good. That's it for that one. Let's look at the other chapter 11. Extra questions. Okay. And we say the number of shares that a corporation charter is allowed to sell is referred to as their authorized shares. Okay. A corporation issued 6,000 shares, $2. Oh, same question. That question was so great, I fell in love with it twice. Right?
Yeah.
Number 3, preferred stock which confers right to prior periods unpaid dividends, even if they were not declared, is called what? Cumulative, right? Okay, so those will accumulate no matter what. Okay, they declared 6, the remaining 2,000 accumulated, didn't it? It got carried forward to the next year. Okay. Torino Company has 10,000 shares, $5 par value, cumulative, and non-participating preferred stock. Now, we didn't talk about non-participating, and I'm not going to make you do calculations of non-participating. But if preferred stock is participating, that means that I go ahead and I do what? I first pay my preferred stockholders a dividend. I then go ahead and I catch up my common stock shareholders, catching them up so that they've gotten at least as much dividend as the common stockholders. And then any amounts that are left over get distributed evenly between, not evenly, but proportionately between the common shareholders and the preferred shareholders. Okay. Now the fact that this is non-participating makes this work just like we saw in the question, which is what? The accumulated amounts need to be paid to preferred. Anything left over goes to what? Goes to the common shareholders. Okay. So they tell us the company paid a cash dividend of $1,000 in its first year of operation. The cash dividend that must be paid to preferred shareholders in the second year, and so it's going to be calculated, and you can see that we have the 10,000 shares times the $5 times what? 4% means that they get a dividend of 2,000. The prior year dividend in arrears, though, is what? 1,000, and so we have the what? Arrears plus the current dividends. That means that what? The preferred shareholders are entitled to $3,000, right? 1,000 from the previous year that was already paid to them, plus the amounts that have accumulated for the current year, the 2,000. Okay. Question?
Just gonna get one of arrears dividend is.
The 1,000 is the amount that's in arrears here, because it was from the first year. The company paid a total cash dividend of 1,000, so they paid them the 1,000, but they get 2,000 a year, don't they? 10,000 shares times $5 times it's 0.04, okay, gives you 2,000 per year, right? They paid them 1,000 in year one, right? So the amount that's in arrears is the amount that's left over from year one. That's that 1,000 that they didn't get in year one.
Why didn't they get it?
Because they only declared 1,000.
Okay.
Okay, but the cumulative means it accumulates whether they declare it or not, right?
Yeah.
So they only declared 1,000, so that means the remaining 1,000 did what? It accumulated, and that 1,000 is said to be in arrears. Okay. Then the next year they get another 2,000 coming, don't they? And so the amount that they have entitled to them is the 1,000 in arrears plus the 2,000 current year, which is 3,000. Samantha?
So declare, it's just when the company says how much they're going to pay regardless of what they actually are required to?
There's no requirement.
Or like what the deal is?
Yes, declared is what they call out that they're going to, what they've declared as a dividend, and it doesn't have to match what the preferred, what you call the deal is,
Yeah.
that it's, this 4% times the par value, right?
Yeah, so then it just adds up in the arrears.
It'll add up in arrears until it is finally declared, and then obviously, and then of course, then it gets paid. But paying it is irrelevant. It's the declaring. Okay, if they declare it, then it belongs to the dividend of the year that was declared, and any amounts that are the amount of dividend that they were supposed to pay them, less the amounts that they've declared, is considered in arrears. So in this case, they had what, 2,000 doing the formula. There was 1,000 that was declared, so there was 1,000 that was in arrears, right? And then the next year we have the current dividend of 2,000, which we have every year. That's what brought us up to the 3,000. Alyssa?
So if you own preferred stock and you end up selling it even though you have arrears, you just lose that and the company like makes a profit off of that, or like more retained earnings?
I think
Or
the
they
new
pay-
shareholder would get it. Whoever you'd sell it to, they're the ones that would be paid to.
So when a company issues stock, they could issue common or preferred, and they could be at different par values.
The what?
They could be at different par values.
Different par values? Yeah, they probably will be. The par value for preferred stock tends to be higher, right?
Okay.
Can you sell under par value?
No, that's the point. Sometimes the par value is called the legal par value. Okay, so typically, no, you can't sell below par value. That's the point of par value.
Even if it switches next time you issue stock.
I don't understand that question. Is that a trick question? What do you mean, even if it switches after that, when the next time you sell
So
stock?
what I was saying is, if you issue stock at $1,
Yeah.
and then you issue more at $1 par, it's $10 now.
You mean if I go back to the state and say, instead of my par value being $1, I want it to be $10?
But
Yeah, you can't be just that. That's in your articles of corporation, what the par value is going to be. Is there a question over here?
Why doesn't the company have to pay their preferred stockholders $2,000 in year one? I know the problem says that they only pay $1,000, but like preferred stockholders are supposed to get accrued and whatever like they're supposed to get. Why don't they get 1,000 to 2,000?
Because you can't get rock from water from a stone. What if the corporation doesn't have the cash resources to pay a dividend? Are you going to beat them and force them to pay the dividend? Make them liquidate to pay the dividend?
Well, no, but like it says that the cash that must be paid. So I thought I don't know.
Well, it says Torino Company has 10,000 shares, $5 par number for stock. Par value. The company paid total cash dividends of $1,000 in the first year. The cash dividend that I see what you're saying, that must be paid to the shareholders in year two. That's a bit
That's what I'm saying. If you
elementary. You don't have to pay them. I don't know why they're saying that must be paid, because there's no requirement that you pay a dividend. Obviously, from the first part of this problem, they only paid them $1,000. Your question, right? They only paid them $1,000. I have no idea why it's saying
So
it
is that
must be
3,000
paid.
what they like are entitled to, but not exactly what they must pay them?
It's the amount that would, if they didn't pay them anything in year two here, then that would continue to accumulate. We'd have.
Okay. But accumulates, but you never have to pay them, and just like accumulate it and not do anything.
Yeah, you don't have to pay. They just accumulate.
Okay.
Jordy?
Doesn't it just say like must be paid because it says before any dividends is paid to the common one? So
Oh, okay. Thank you. So the rest of that sentence answers it, because you've got to catch up any amounts in arrears
Okay.
before you can pay. That's why. Okay. Thank you. Thanks. Good observation.
So if it's not cumulative, then are there no arrears?
If it's not cumulative, there's no arrears.
And
If it doesn't accumulate and they don't declare a dividend, it's like a video game, right? It goes off and that's it, and we start over again next year.
So then the only benefit in that case for having preferred is because then next time they pay stock, you'll get money for that if you're talking about like.
You at least get paid before the common shareholders, typically with the preferred, and you might get a little better dividend, right? Yes. Why do we even do this?
Yeah.
Well, if I'm buying preferred stock, I've got a funny feeling that some dividends are coming, right? I'm willing to pay a little bit more for the stock, so I'm not a growth company. I'm not, what do they call that? You buy growth stock. Growth stock, you're not buying it for the dividends, you're buying it for what? You're buying it for the growth, right? As opposed to what do they call it? You guys are more in tune to this than I am. They call it income stock, where you're buying stock and you're probably wanting the dividends. So someone my age is probably buying what? Income stock. Someone your age is probably buying what? Growth stock. And so this is a bunch of old people buying preferred stock. They got this money sitting here and they're able to pay this, and they're sitting there expecting that, okay, the company will either pay me a dividend or they're going to pay me a dividend pretty soon, and when they do, it'll accumulate and I'll get paid before anybody else does. Why is my computer doing this? I see the plug. I see it. But it's not plugged in. Question? Okay, let's take a look at, is there another one here? Okay, so Gacy's department store has $200,000 of 6% non-cumulative, non-participating preferred stock. Gracie also has 600,000 shares of common stock. During the first year, the company paid dividend of $30,000. The dividend should be distributed as follows, and notice that the preferred are going to get what? 200,000 times the 6%, so they're going to get this 12,000, aren't they? Okay, and since the total dividend here was 30,000, the remainder goes to the preferred shareholders, right? Common shareholders. Now, if there had been dividends in arrear, let's say the problem told you there was $2,000 dividend in arrear, then the dividend in arrear would get paid first, wouldn't it? And then the rest would go to the common shareholders. Well, in this case, yes, that's right. In this case, you're right. It's non-cumulative, right? You're right. So it would not have, if they didn't pay them they didn't declare it in the first year, then it wouldn't accumulate to the second year. Not if no, we do not.
Why does the common stock get more than the preferred?
Because the preferred got caught up, and since they're non-cumulative and non-participating, they just get whatever got declared for that year. If they were participating, okay, if this problem said they were participating, what we would do is we would give the preferred shareholders would still get their 12,000, right? Then we would go ahead and we would catch up our common stock people, and we would give them 12,000. So now each got 12,000, and then they got caught up. So now there's what, 6,000 left out of the 30,000, 24,000, 12,000, 12,000 out of 30,000. There's 6,000 left. Hello? Okay, so there's 6,000 left, right? Now, how do we decide who gets what? Do they give me the number of shares here? They do not. But what I would have to do is just pretend they said there were 2,000 shares of preferred and say 4,000 shares of a common. So the total shares, the common and the preferred, total up to 6,000, right? 4,000 of common, 2,000 of preferred. So now what? So now the preferred people would get what? Would get $2,000, a third of that 6, and the common people now would get what? Would get the balance, which is going to be this would be 4,000, or 2/3 of the 6. Okay, and that's what it means to participate in that what? After we catch up the common shareholders, any additional amounts, both participate, and as I said, proportionately. Okay, but we're not going to do that on the exam. All you need to know on the exam is what? If it is cumulative, it does what? Well, 3 things. Just write this down. These are the 3 things you need to know for the exam. 3 things you need to know for the exam as it relates to the dividends here, okay? The preferred stock dividend. Number 1 is preferred shareholders get paid dividends before the common shareholders, right? Preferred gets paid before common. Preferred gets paid before common. 2, cumulative dividends must be paid to the preferred shareholders before anything gets paid to common shareholders, whether the dividend is declared or not. Cumulative dividends must be paid to the preferred shareholders, whether the dividend is declared or not. Is that what I said? Right? Let's say 3 things. How many I give you? 2. That's it. Because we're not going to get into the participation.
Are there dividends?
Huh?
Are there dividends? Yeah, what about? I thought you could only do
Dividends have to be declared to be paid, but the dividends accumulate whether declared or not. So maybe that's the second thing.
What do you mean? Whether declared? You mean like?
They accumulate even if they're not declared.
You mean? Well, they have. So how would we know? Right. So you mean like 1 year, like the next year?
How would you know what? Huh?
Like, how would we know that there was dividends within, what does that mean?
Like, do you mean like year 1?
They accumulate whether they're declared or not. So if, guys, come on, we can't have 3 or 4 classes going on at once. They accumulate whether they're declared or not. Like in that one problem, they only declared 6,000, but 2,000 accumulated, didn't it? Which problem was it? What was that mean? One of these had a problem, okay, where they did what? Well, they said that they paid, but there was another one where they declared an amount. That was in the slides, right? Which I've now closed. Chapter 11. Just a second, let me find the slide. I can only answer one question at a time, guys. Okay, this slide right here, on December 31st, 2015, 1,000 shares, 8%, $100 par value cumulative preferred stock. It also has 50,000 shares of par value common stock. And December 31st, they declare a cash dividend of 6,000. Okay, but the remaining 2,000, because the total that they were supposed to get, you said per the deal, okay, for the formula here is 8,000. So 2,000 did what? 2,000 was in arrears and went forward to the next year and had to be paid before they could pay the common shareholders. So even though they didn't declare it, it still accumulated. So cumulative dividends accumulate, sounds kind of redundant, but they accumulate whether declared or not. That's the second thing. that you should write down. Yeah, and it's based on whatever the deal was, whatever they tell you the formula was. Okay, so the second thing was cumulative dividends accumulate whether declared or not. Cumulative dividends accumulate whether declared or not. And what? All dividends must be paid to preferred shareholders before the common shareholders can have theirs, which includes amounts in arrears and amounts declared for the current year, right? Right?
How long can it accumulate for? Is there no?
It keeps going. It could accumulate. It'll just accumulate and accumulate and accumulate and accumulate, and the common stockholders get further and further and further back in line until there's finally a payout. The preferred will get theirs. The common will get theirs. If it's fully participating, we'll catch up the common so they have as much as the preferred, and then we distribute any additional amounts based on the ratio of how many shares you have of common versus preferred. Yep. That means they declare it. Like I can declare, I am the best accounting teacher ever. I just declared it, you know? And that doesn't mean it's true. But in the case of the board of directors, they're declaring, they're saying, we are going to pay a dividend. Yeah, they'll say, we declare that we're going to pay a dividend of, man, it's hot in here, I declare. It's just somebody saying, calling something out. I declare. Quiz on number 4. The extra questions or the regular quiz? Okay, number 4, 10,000 shares, $5 par common stock, 4% cumulative and non-participation preferred stock, 100,000 shares of $10 par value common stock. So you take the what? You take the 10,000 shares times the $5 per share times 4% means they get $2,000 a year per the deal, per the formula, right? Right? Okay. In year 1, and they'd say they paid. By the way, they don't have to say they paid. They could just say they declared, but whatever. They paid, if you paid it, they declared it, $1,000 dividend. So that's that $1,000, okay? But they owed them what? They owe them $2,000 per year per the deal, don't they? The deal is 10,000 times $5 times 4%. That's $2,000 a year, right? Okay. They paid them $1,000, so they still got $1,000 coming, don't they? From year 1, plus year 2's, they get $2,000 a year, don't they? So before we can pay any amount out to the common shareholders, we have to pay amounts out to the in arrears to the preferred, and then get them caught up in the current year, and then we can start to pay amounts out to the common shareholders. It accumulates until it is declared. They have no rights. It can continue to accumulate forever. And if it's never declared, then it's never going to be paid to them. They'd have to pay $2,000 times 100 years before they could pay anything out to the common shareholders. By then, they would all be dead, though. And that would be a very poor investment. Okay? Okay, good. Let's go ahead then, and let's take a break. We'll take 10 minutes, and then we're going to come back and get into chapter 12.
that one, you have like the preferred stock, and you get 2,000 that first be paid, and you said that in year one they paid 1,000, but like and so then there's like 1,000 left
That's
over.
important thing is they declared 1,000.
They declare 1,000 in the first year. Or,
Yeah,
So like
declared or paid is indifferent.
so like, but how would you know that if they paid 1,000 to like only the preferred or to preferred and non-preferred, or does it like not matter? Like the
It doesn't matter. I mean, I would assume. Well, we can assume that they didn't pay any to the common, because how could they still have 1,000
that's-
left over to go to the
Okay.
here? So I'm going to go ahead and resume the recording, and I'll go ahead and put the video up on B courses, okay? And we're going to talk about statement of cash flows, but before we do, I wanted to just look at this balance sheet, okay, of this company. And you can see that they had cash at the end of 2014 of $55,000, and they had cash at the end of 2013 of $33,000. So they do indeed have an increase in cash of $22,000, right? Now, if you're looking at this company and you see this cash increasing $22,000, what are you thinking? That's good. It's not bad. Maybe they made a profit. Maybe they didn't. I don't know. I know their cash increased. Maybe they borrowed this $22,000, right? Or this, yeah, it's $22,000. So they didn't necessarily have a profit. If they borrowed the $22,000, are they going to pay me a dividend? Probably not. But if they made the $22,000 from having a profit, hey, we're at least heading in the right direction, and maybe we're going to get a dividend, etc., right? Okay? But we can't tell just by looking at the change in cash for the period. So what companies do is they are required by FASB, okay, by the accounting standards, to prepare something called a statement of cash flows. Now, so far, we have learned about what? We have learned about the balance sheet. We've learned about the income statement really first, didn't we? And then we spent some time, whether you noticed it or not, we've been hovering around the balance sheet. And we've been talking about this statement of cash flows. Oh, come on. This statement of cash flows, which is one of the statements that needs to be prepared by an entity. Now, what does it help us to do? It helps us to understand something about the entity's ability to generate future cash flows. If it's all coming from borrowing, that's not real good. If it's coming from what? From a profitability standpoint, that's going to be good that they're going to be able to generate those in the future. What is their ability to pay dividends? If it's coming from borrowing, if it's coming from issuance of more stock, now I'm getting further and further in line behind those preferred shareholders if there's going to be a dividend, right? Maybe the cash came in because they issued a bunch of preferred dividends. I'm further behind now than I was before, right? Okay. Reasons for the difference between net income and the net cash provided by operations. And we're literally going to see that we are going to reconcile to our net income to a cash provided by operations number. And when we get that, that is going to be very helpful to us to understand the sources of the cash, okay? And then whether cash came in through investing, people buying our stock, or financing, we borrowed the money, we'll be able to determine that from the statement as well, okay? So when you look at this statement, we have three categories: operating, investing, and financing, okay? And I'm going to give you some hints as to how to remember where we report the various activities, what activities, what transactions, if you will, get reported in these various categories, okay? Now you come over and we have our operating activity. That tends to be our income statement items. We have our investing activities, okay? Now when we have investing activities, it tends to be that we are either investing in our property, plant, and equipment, we're buying equipment, etc., or potentially we've done what? We've bought stock in another company, or we've bought the bonds of another company. We're making an investment in those companies, okay? And we can increase our cash or decrease our cash from these transactions. Financing activities means what? We have acquired financing, and typically the two ways that we talk about, at least in this class, for financing activities is either through issuance of our own stock or issuance of our own Bonds would be considered financing activities. Okay? Okay, so we go over now and we see the three categories, and we see that you have these different companies. Everybody loves Kohl's, right? And we have what? We have our net income and we have our cash provided by operations. Are these numbers different? Okay, and they're different because what? Not all of our income is in cash. We may have had a sale in which we had a credit sale and we're still waiting to collect on that credit sale, right? Okay, so there would always, almost always, I can't think of a circumstance where there wouldn't be a difference between our net income, which is an accrual number, and our cash provided by operations, which is a cash number, obviously. Okay? Now, when we prepare our statement of cash flows, we can either use the direct method or the indirect method. I am only holding you accountable to the indirect method. I'm only holding you accountable to the indirect method. And it really only affects the operating activity section, the difference between these two methods. Okay? Now, when you take a look at this question right here, okay, well, we can do this. Let's do this. Okay, now when you take a look at this slide right here, we have operating, we have investing, we have what? Financing. Okay, now investing activities are going to be, and you just think of an investment department in a company. The investing department in a company is going to do what? You're going to say, hey, you got cash, go make investments. So what are they going to do? They're going to buy equipment. They're going to buy building. They might buy a piece of land to see if it appreciates in value. They might buy the stock of an up-and-coming company. They may buy the bonds of a company, right? But they're making investments, okay? All of that activity would go in your investing activity section. Financing activity section is going to be, and you can just think of your financing department. What does your financing department do? We need money. And so we tell our financing department to get us money. How could a financing department get money? They could borrow, or they could issue our stock, right? It's going to be our primary financing activities, okay? And then operating activities are going to be basically activity that relates to items that are not investing and not financing, okay? So with that as an understanding, let's take a look. We issued 100,000 shares of $5 par common stock for $800,000 cash. Is that financing, investing, or operating? Financing. Good. You're getting it already. Borrowed $200,000. Financing. Good. Purchased 2 semi-trailer trucks. That's investing. We made investment in equipment. Excellent. Okay. Paid employees $12,000. That's operating. That's our day-to-day operations. Collected $20,000 cash for services provided. That's going to be operating. Good. You guys got this already. You already studied this somewhere? You lied. You studied this already. Okay. All right. That's all right. We'll keep going. Okay. So what happens? When we do this, we're going to have what? We're going to have 3 sources of information. And the thing that's kind of cool about the statement of cash flows is after you do all the accounting, then you just pull the statement of cash flows from the other 2 statements. So you prepare your income statement, you prepare your what? Statement of retained earnings, just balance sheet, and then you take those statements, and if you follow the rules that I'm going to give you, you can pull a statement of cash flow from that. Okay? Okay, good. So let's just go ahead, and everybody uses the indirect method, even though FASB would rather you use the direct method. Now, why is that? Are they just defiant children? Huh? You say, oh, you want me to use indirect? Direct? Well, watch me use indirect then. Why do they do the opposite of what FASB asked them to? If you look at the direct method, we're going to see that they're going to call out things like cash paid to suppliers, cash received from customers. I forget who was asking me the question. Can you back into some numbers on the balance sheet to get information about what a company's paying to their suppliers and stuff? And my comment was, well, if they prepared the statement of cash flows in direct method, there wouldn't have to be any calculations. You would just see it right there on the face of the statement of cash flows. But that's information that companies may consider a bit sensitive, right? So FASB gives them the option of the indirect method where they won't have to report those sort of things. And as a result, everybody takes the indirect method because they don't want to have to report certain information that they think might be a little too sensitive. Okay, so most companies use indirect. So that's where we're going to spend most of our time. Okay, so we have our income statement. Our net income is how much? $145,000. Okay, and then what? Then we're going to prepare our statement of cash flows using the indirect method, and we will start with our net income of $145,000, and then we're going to start to make adjustments that will bring us to our cash provided by operations. Okay? Easiest point on your exam will be to do what? Add depreciation expense back to our net income to get cash provided by operations. What's the journal entry for our depreciation expense? Debit depreciation expense for, what is it, 9,000? 9,000 here? Am I picking up the wrong number? Right, 9,000? And credit accumulated depreciation, you say, up here for 9,000? Okay, did any cash go out? No cash went out, yet our what? Our net income came down, didn't it? So if we want to get to cash provided by operations, if we take our net income and add the depreciation back, that's getting us towards a cash number, isn't it? Okay. Now you take a look and they start talking about loss on the disposal of plant assets, $3,000. Well, let's say that I have a plant asset, and let's say the original purchase price is $100,000. Accumulated depreciation is $70,000. What's the book value of that asset? Book value is $30,000, isn't it? Okay. Now let's say I sell this asset for $27,000. Who wants to give me the journal entry for that? Huh? I'm going to debit cash for $27,000. Debit loss, good. On disposal of asset, $3,000. Go ahead, Paul. Credit the equipment for, no, $70,000 was the original cost. Got to get rid of the equipment, right? And then what do you want me to debit to make the journal entry balance? Debit the accumulated depreciation. You got to get rid of that, don't you? And the accumulated depreciation, I said, was how much? $70,000. How much was the equipment? Equipment was $100,000. So I have to debit the accumulated depreciation to 70, right? Is that journal entry balance? Yeah. It's a miracle. It balances, right? So I've gotten rid of that equipment, haven't I? Right? Now, I'm showing a loss of $3,000, which is going to reduce my net income, isn't it? Yeah. But is that the amount of cash that came in here? The amount of cash that came in here is $27,000, isn't it? Okay, so what I'm going to do is I'm going to go ahead and add back that loss of $3,000 because that's not my cash situation. My cash didn't go down $3,000 and it went up $27,000, didn't it? Yeah. Right? And then I'll take that $27,000. If I buy equipment, where do I report it? On the statement of cash flows. If I buy equipment, where does it go on the statement of cash flows? Investing. Good. So if I sell that equipment, that belongs in the investing section, and I'll show proceeds from sale of equipment, $27,000. Is that now giving me the cash number? Is that giving me the cash number? Proceeds is $27,000, right? Okay, but right now in the operating section, I'm making an adjustment for what? For an accrual number of the loss to get to what? add that back because that's not affecting my cash to what? To then go ahead and put in the cash value in the investing section. Okay? Now, we have this decrease in accounts receivable and increase in inventory, and I don't know why increase in prepaid is up there. I mean, why it's red. I know why it's up there, but I don't know why it's red. And so we have those, and those are being adjusted to get to cash provided by operations, right? Okay? Now we come over and we get to our full statement of cash flows, and we have what? We have the net cash provided by operating activities, cash flows from investing, purchase of building, that's investing. I don't know why some of these are red, guys. Purchase of equipment, that's what? That's investing. See, disposal of plant, 4,000. I didn't look at this ahead of time to create an example that would have tied to what we should have shown there. In our little example, we would have shown what? 33,000, right, from the sale of the building, even though they're showing 4,000. Guys, don't get confused by the fact that my number doesn't match that. I just made those numbers off the top of my head. This is in a different example where they're just showing you 4,000, right? Okay, let me do an example that's exactly like this. So there's no possibility that any other thing could have happened here. So the purchase price of this asset is 5,000. Purchase price of the asset is 5,000. The accumulated depreciation is going to be going to get to a 2017. Purchase price of the asset is 12. Do it that way. The accumulated depreciation is 3,000. That means that the book value of this asset is what? 9,000. Okay. How am I going to do this to make it back into these that number? And so I'm going to go ahead and I'm going to sell it now for a loss of 4,000 on this. I have to sell it for 5,000, right? Okay. Not, I want a loss of 3,000, right? So I have to sell it for 6,000, but that won't be 4,000 cash. I don't know how to make it back into this example. Okay. In our example, this would have been $33,000. Okay. In the example that I made up, it doesn't tie to this. Okay. I'm just simply telling you where you would report the actual proceeds, and the actual proceeds in this case was what? $4,000, right? Okay, so 4 plus 4,000 plus 3,000 is what? 7,000. So the original cost of the asset would have been what? It had to have been 12,000 minus 3 is 9,000. Okay? And so I'm going to go ahead and I'm going to debit cash 4,000. Cash is coming in. I would have credited equipment for how much? 12,000. I would have debited the accumulated depreciation for how much did I say it was? 3,000. And I would have gone ahead, what's that, 7, 12, I would have needed $5,000. I can't do it, guys. I have to sit here and I have to figure it out sit down and figure it out for myself to get it so that it matches exactly to this. But I'm telling you that in our example, this number would be, what was it now? 33,000 following the example that I got. 33,000 would be reported there. What the loss is the difference between the book value of the asset and what I sold it for, right? And apparently they sold this asset for 4.
Sorry, why is it 33 and not 27?
Oh, I'm sorry. Oh, I forget. How much did I come in with?
Well, you said you sold it for 27.
Oh, okay, if I sold it for 27, you're right, it'd be 27,000. I just forgot the number. That's the $27,000 cash that would come in from the sale of this asset, right? Oh, I'm sorry. Okay. Yeah, if that was your question, you should have asked that like 15 minutes ago. So the debit to cash is 27,000. Okay. And so that's the amount of proceeds that go there, right? Yes, sir. Well, since cash got debited over here, cash increased, so I add it to get to the change in cash, right? Hang on a minute. I can't let this go. Since cash increased, I add it. If cash decreases, I subtract it, right? Hold it a minute. You asked me one question. You can't jump to another thing that I haven't taught you yet. So you understand that what? Since I increase cash, I add it, right?
Yeah.
Okay. Question? Okay. Okay, good. So I go ahead and I put that there in the investing section as a takeaway from that, right? Okay. Then what? Then we come to financing activities. There's my what? There's my financing department issuing common stock. There's my financing department paying the dividends out, right? If I issue stock, I have to pay dividends. That's part of all of my investing activity. That's my investing department. Okay, and then of course the change in cash for the period we already saw was 22,000. Beginning cash was 33, so ending cash is 55, right? Okay. Guys, if you're sitting there and I see a little bit of a skepticism as though I'm not going to be able to explain this to you, get that out. Just purge that from your mind, because you're going to be explaining the statement of cash flows like you never have before. Okay, so just purge this, that somehow this is going to collapse, because it ain't going to happen. Okay? All right, so what we're going to do is we're going to go ahead and yeah.
Okay, so then for the, the depreciation expense, okay, that's it. So even though the depreciation expense on everything else would like decrease, since there's no cash exchange, we're adding, that's why we're adding that.
Yes, because there's no cash in that transaction. Since there's no cash in that transaction, you add back the depreciation.
So we're just adding back everything we paid for that wasn't cash. Or like,
Do you understand the depreciation?
yeah.
Okay, stop. That's all I want you to understand right now. You guys are trying to jump to the next thing, and I haven't taught it to you yet. Hang on. Do you understand the depreciation? Okay, hang on. Okay, now we come over and we take a look now at the board here. I'm going to go ahead and put the screen up. This thing is going to blank itself out for some strange reason, but that's okay. We're just going to unplug it. Okay. Guys, I'm telling you, if you keep trying to jump me on this, it's going to you're squandering the opportunity to learn it so that you'll be able to get the question correct. We're going to go ahead and we're going to do a company. And we're going to do a couple transactions with this company. And so the company goes ahead and it has some sales on credit. So they go ahead and they debit accounts receivable, say 100,000, and credit sales, 100,000. Okay, they just start business. This is their first transaction. Then they go ahead and they pay some expenses. They debit expenses for 40,000, and they credit accounts payable for 40,000. Okay, now that's that first year of operations, and so they go ahead. This is year one, and in year one, they go ahead and they prepare their income statement. And we prepare the income statement. How much is their sales? Sales is 100,000. Expenses are what? 40,000. Net income is 60,000, right? Okay? Now, when I prepare the balance sheet, I'm going to have accounts receivable of 100,000. Let me write this smaller here. I'm going to have accounts receivable of 100,000 at the end of the year and 0 at the beginning of the year. 100,000 at the beginning, 0 at the beginning, 100,000 at the end, right? Accounts payable is going to have had what? 0 at the beginning of the year. My accounts payable. In my balance sheet, accounts receivable is 100,000 at the beginning of the year, 0 at the beginning of the year, 100,000 at the end. Accounts payable is 0 at the beginning, and how much at the end? 40,000. And I'm just going to put my retained earnings down here because I can't seem to resist putting what? 60,000 would be closed out to my retained earnings, although it's not relevant to this example. We just started business, right? What was the accounts payable at the beginning of the year? Accounts payable was 0 at the beginning of the year. What was the accounts receivable at the beginning of the year? 0. So did we have a change in these accounts? Do we have a change in these accounts? So accounts receivable did what? Increased for 100,000. And accounts payable also did what? Increased for 40,000. So we've got 2 increases on these balance sheet accounts, don't we? Okay, and as I said, you prepare the income statement, you prepare the statement of cash flows, and the balance sheet, and then the statement of cash flows, they give birth to it, essentially. It just comes out of those two, don't they? Okay? And so what happens? When I prepare the statement of cash flows, I'm going to start with net income. How much is my net income? 60,000. And I will go ahead and subtract the decrease. I don't have to say subtract. Let's subtract it. But I will subtract the decrease, not decrease, but what? Increase in accounts receivable. I subtract that increase in accounts receivable, which was what? 100,000? The accounts receivable increase 100,000? I'm going to subtract that. And for my accounts payable, it increased, didn't it? And for my increase in accounts payable, I'm going to go ahead and I'm going to add that increase, 40,000. And when I add that increase, 40,000, do I get my cash provided by ops? Do I get my cash provided by operations? Cash provided by operations is 0, isn't it? Is there any cash on my balance sheet? Is there any cash on my balance sheet?
No.
There was no cash starting. There was no cash ending. I had a 0 change in cash. I just went from my accrual net income to my cash provided by operations, didn't I? Did this work so far? Did it work? Did my cash go to 0, stay at 0 the whole time? And so my cash provided by operations is 0, isn't it? There was no cash provided by operations. Year 1? Year 1? Is that year 1?
Yeah.
Okay. All right, good. Now we're going to go ahead and we're going to jump into year 2. And in year 2, the only thing...
I get the math, but why is it that you increase accounts receivable?
I'm not ready yet. I'm not done yet. You cannot take the machine from the computer, the information from the computer, faster than the computer is going to give it to you. Okay, so you just need to take it as it comes. It's like a TV show, like a movie. You don't go to the movie and say, excuse me, how did that, right? Just let the plot come to you, okay? All right, so what happened? Now we go ahead and we have the situation where we go into year 2, and in year 2, they collect, let me make it, what's my accounts receivable? 100,000? Okay, so they collect 30,000 of that accounts receivable. So if they collect that, they're going to do what? They're going to debit cash for 30,000, credit the account receivable for what? 30,000. And they're going to take some of that cash and they're going to pay the account payable. So how much is the account payable? 40. Let's pay 10 of it. Let's pay 10 of it. So they'll debit the account payable for 10 and they'll credit the cash for 10, right? Right?
Yes.
Okay. Now I'm going to prepare my income statement. Do I have any revenue? Do I have any revenue? I have no revenue. Do I have any expenses? Do I have any expenses? I have no expenses. So my net income is how much? My net income is 0. Okay? When I prepare my balance sheet now, do I have any cash? Cash started the year with what? 0 at the beginning of the year, and by the end of the year, cash is how much? No, it's 20,000. It went up 20,000. When you want to increase cash, you debit it. When you decrease it, you credit it. That's a net of 20,000, right? So cash did what? Cash increased 20,000, didn't it? Did cash increase 20,000? Okay. My accounts receivable did what? My accounts receivable started the year at 100, and now it is at 70,000. So it does what? It decreased. I'll just go ahead and put that in parentheses. Parentheses means when it decreased. It decreased 30,000, didn't it? And my accounts payable did what? My accounts payable decreased. It started out the year at 40. It ended up the year at what? At 30. So it decreased 10,000, didn't it? Right? Okay. So now I'm going to go ahead and I'm going to prepare my statement of cash flow. What's my net income? Net income is 0. My accounts receivable did what? Accounts receivable decreased. And since I decreased my accounts receivable, I'm going to, Alyssa, add that. And the reason I'm adding it is what? I have cash that has come in. It decreased my account receivable. That's purely a balance sheet transaction, isn't it? Doesn't affect net income. So I add that back, right? Whereas in the first year, I subtracted it because what? I brought in a receivable and it did what? It had generated sales, right? And there had been no collections against it, so I subtracted it. Okay? Then what? Then for the accounts payable decreased, didn't it? And since accounts payable decreased, I've used up some cash. Meanwhile, what? It didn't subtract from my net income, did it? Did it affect my net income? Okay, so I go ahead and I do what? I add that back, that decrease, I subtract that, because it used up cash, but it didn't affect my net income, right? So I subtract that, and I get my cash provided by operations, let me restate that because I didn't state that right about accounts payable. Accounts payable did what? It used cash, but it didn't affect my net income, right? It used cash, but it didn't affect my net income, so I have to subtract it, right? And so when I subtract that, my cash provided by operations is how much? 20,000. Is that the change in cash? 20,000? Okay. Okay, good. Now we go into year, wait a minute, before we go into year 3, when we are dealing with cash flows, stop feeling sorry for yourselves, guys. It's not healthy. It's not helping you. When we deal with cash flows from operating activities, okay, we're going to have our current items, we're going to have amortization, we're going to have losses, amortization, we're going to have losses and gains, and we're going to have depreciation. We're going to have current items, amortization, losses and gains, and we're going to have depreciation. Current items, amortization, losses and gain, and depreciation are going to go in the cash flow from operating activities. And if you use the first letter for each one of those, that spells collod, which means that I wanted it to spell clad. Okay, so you have to do it in this order. Current items, losses and gains, amortization, and what? Depreciation. That spells clad. Current items, losses and gains, amortization and depreciation is clad, right? You are smart enough to figure out that even though he wrote the letters in the different order to spell, this goes first, this goes second, this goes third, and this goes fourth. That spells what? Clad. Those are the items that go there, right? Now, when we analyze the current items for assets use opposite direction. For assets use opposite direction. For liabilities use same direction. For assets use opposite direction. For liabilities use what? Same direction. For assets use opposite. For liabilities use what? Same. Okay? Now when you look at that, that's exactly what we did on the statement of cash flows. What do? The asset accounts receivable increased, didn't it? Did it increase? Huh? In year one? It increased, so what do? We subtracted it. Okay, now you can just remember that based on what I wrote on the board, but you could also just think of it logically and then what? Yeah, if accounts receivable increase, we take a sale, but no cash comes in. Accounts receivable increase, we took a sale, no cash comes in, right? So if account receivable increase, it's an asset, what do? The opposite, you subtract it. If it's a liability, well, let's look at accounts receivable in the second year. Accounts receivable in the second year, accounts receivable did what? It decreased, so we added it, and it makes sense that you would add it if it decreases, because what? Cash came in, even though there was no income generated with that, right? So you add it? Okay? If we're talking...
if you have to like debit an allowance, like decrease your accounts receivable, there's still worth cash.
If you debit the allowance, what did you credit?
Your accounts receivable.
So my accounts receivable would, there's absolutely no, huh?
So when your accounts receivable still decrease, but then you'd be adding cash that didn't.
There's no cash affected by that at all. So the fact that I wrote off a receivable would have absolutely no impact on the reconciliation of net income to cash provided by operations.
Right, but then when you close it out, then you look at if it decreased or increased, like the accounts receivable, and then you see that it decreased even though there's no cash.
If you're talking about the net receivable decreasing as a result of that, and the allowance decreasing as a result of that, I would take each one of those separately, right? If you want to do it that way. And so the fact that the accounts receivable decreased and the allowance increased, I would add back the allowance to account receivable, right?
Okay.
The change, I should say. Okay, so for that, a contra asset, it works like a liability.
Okay.
The allowance went down, so I add it, right?
So that'd be like another process.
Yeah, yeah. Okay? Okay, now, if you look at what? If you look at year 2, since it's decreased, I do what? I add it back, don't I? Right, because I had cash that came in, 30,000 cash came in from the collection of the account receivable. Meanwhile, there was no income generated with that. My revenue was 0, wasn't it? Okay? With my expense, it did what? I mean, with my accounts payable, it did what? Accounts payable decreased. That means I used cash even though there was no expense associated with that, right? So if we're sitting here and we're dealing with our liability, we use the same direction. Since it decreased, we subtract it, right? Okay? Now ask your questions. Now ask your questions. Yeah, sure. That's probably a good idea. Let's put that up. Assuming it'll come back now. Oh, I guess I gotta turn the, put the screen down or it won't show up there.
The projector turns off, so in the podium, there's like a motion podium on top. Like you have to open the podium. Like you see the door.
I'll just I'll just turn it off here. Because I think it needs to cool down now as part of the formula here. Okay, system on. We have to wait for it to warm up. We have to wait for it to cool down. Up top. Okay. Okay. So let's take a look now, and let's start right here. Okay, and when you look right here now, notice that what? We went through each item, assets, okay, and then we continue, and okay, we didn't go through the liabilities here, unfortunately, but we would have gone through the assets and liabilities. And here we went through the cash decrease to $22,000. We want to explain that, right? My accounts receivable decreased, didn't it? And so since my account receivable decreased, what do? I add it back, don't I? Asset decreased, you do the opposite. You add it back. Okay? When you look at the what? $5,000 increase in inventory. Inventory is an asset, isn't it? And if it increased, I'm going to go ahead and I'm going to do what with it? I'm going to subtract it. Now you sit there and say, well, what if you didn't pay cash for that inventory? That's okay, because what? I'm going to make the adjustment to the accounts payable, right? If the accounts payable increased, I'm going to add it back, right? So the increase in the asset, increase in inventory, I did what? Why is it saying increase in inventory was how much? 5,000. So, I'm sorry, it increased. So I do what? I subtract it. Is prepaid expense an asset? Prepaid expense is an asset. It did what? It increased over here. So what do? I decrease it, right? Okay. Decrease in accounts payable. Oh, here's my liability. Increase in accounts payable, but you can't see here. My accounts payable increased. So what do? I add it, right? Same direction. Okay. My taxes payable decreased, so I use the same direction. I subtract it. And again, if these liabilities decrease, they're doing what? They're using cash even though it's not affecting net income, right? Okay. Now remember, we're looking at current items. We just looked at the current items, right? We're also going to look at amortization. There is no amortization in this particular example. I'm throwing amortization in there because what? When we take our amortization on our, say, our discount on our bonds, what do? We increase our interest expense above the what? The amortization of the discount. We increase our interest expense above the cash interest, don't we? So if we had amortization on a discount, we would add it. If it's amortization on a premium, with the premium, we do what? We subtract the amortization of the premium from our cash interest. So if it was a premium, we would have to do what? We would have to add that to get to cash provided by operations, right? Right? Okay. Now, if we're sitting here and we're dealing with our what? Our mnemonic, we had losses and gains. The loss on the disposal of a plant should have been, was the 3,000 example that I gave, right? To add that back, so we have our losses, our gains and losses and gains, that's the L. And D is depreciation, isn't it? Because depreciation is there. So every single one of the things that you have to know to be able to deal with the cash provided by operations is given to you by remembering CLAD. Our current items, you analyze those. If it's an asset, use the opposite direction. If it's a liability, do what? Use the same direction, right? Okay. L, losses and gains. If it's a loss, we're going to add the loss back. If it's a gain, we would do what? Subtract it, right? Because it increased net income, but that's not the amount of cash it does generate. Losses and gains. LA is what? Amortization. I'll just keep explaining amortization of the bond, discount, amortization of the premium, and then what? Depreciation was the D, wasn't it? Falls in for every single one of those things. Okay? When we get to what? Our cash flows from investing, That's our investing department. So what are we going to do? Invest in the stocks and bonds of other companies. Invest in our own equipment. If we have a sale of equipment, it's not going to be the gain or loss on the sale. It's the actual proceeds, isn't it? Okay. And then we have our financing department, in which we're going to be issuing our own stock, be issuing our own debt, right? Issuing our own stock, issuing our own debt. When you have debt, when you have stock, do you pay dividends on that? So if we had to pay out dividends, dividend payouts would also go in investing. Okay? Question? Yeah, the transaction with the premium and the discount. If I have a cash interest of $50,000, I credit cash for $50,000. I debit interest expense for say $57,000, and I would go ahead and credit the discount, right? I'm sorry, you asked a question. I couldn't possibly. Sorry. So I go ahead and I credit the discount here for $7,000, right? So my interest is what? Expense is $57,000, but the discount is $7,000. So I would go ahead and I would do what? Add back the discount because it increased my interest expense above the cash, right? If it was a premium, I would again debit cash $50,000. I'm going to debit interest expense for say, and I'm just making this number up, $43,000. And so now what? Now I would go ahead and I would debit the premium, right? For the premium amortization. So if it's premium amortization, you're going to do what? You're going to go ahead and subtract it from cash provided by operations to get, subtract it from net income, I should say, to get the cash provided by operations, right? Because you use more cash than the interest expense. So if it's a discount, add it, premium, subtract it. Okay? Okay, so let's go ahead then. And let's take a look at the problems from chapter 12. Actually, you know what? Let's jump into the, so that we get over there. Let's look at the final. The practice final. Since I can't find it on mine, find it off the website. Okay, so let's take a look at this number 17 as an example here. Okay, now let me make that a little bigger. So we have net income of $200,000, and the question is asking for cash provided by operating activities, right? Okay, they give me depreciation. Do you know what to do with depreciation? Depreciation is going to be, no, depreciation is added. Depreciation doesn't use cash, right? So I add the depreciation. Okay. How about dividends paid? Is that going to be part of my cash provided by operations? That's down in the financing section. That's when I issue stock, and then later on I have to pay dividends on it, right? So I struck that one out. How about loss on the sale of land? I add the loss, I subtract the gain, right? Because that adds that amount of net income wherever it went is simply what? I guess I erased it. Is simply what? That's simply a book number. It has nothing to do with the actual cash that came in. In our little example, the cash came in at $27,000, right? Right? It is. Down in the investing section, I show the actual cash that came in. But if I'm going to reconcile net income to cash provided by operations, I have to back that loss out. Because that loss did what? It decreased my net income, didn't it? And I'm trying to get to cash provided by operations. We don't consider sales of land, our land, as part of our operations. So we take the net loss out of there. And now we'll put the whole proceeds where you're feeling it belongs, and you're right, in the investing section, right? And the whole proceeds go down there. Okay? Okay, good. Then what? Decrease in accounts receivable. So since it decreased, we do what? Opposite direction. Is account receivable an asset? Asset, use the opposite direction, so we add it, don't we? Okay? And then what? Decrease in accounts payable. The decrease in accounts payable, we use the same direction, we subtract it, right? Now, if you're reading the book right now, hoping the book will somehow magically speak to you and tell you what I'm talking about here, what I'm saying is that what? If my accounts receivable decrease, then what? Cash came in, but there was no income generated by it, right? If you want the explanation and the logic, here it is. Okay, now I'm telling you the way to remember it, but the logic is that if accounts receivable went down, cash came in, but no income was generated by that cash coming in, right? For my accounts payable did what? Went down, cash got used to pay off with the accounts payable. Meanwhile, this did not affect my net income at all, did it? So what do? I go ahead and I subtract that because cash got used even though it didn't decrease my net income. Okay? All right, let's look at another one.
Why do you add the loss in the sale of land?
Because the land had a original cost and the original cost was $100,000. The accumulated depreciation was $75,000. So the book value of this property was $25,000. And if I sold the property for $10,000, I would debit cash $10,000. I would go ahead and credit the equipment for $100,000, debit the accumulated depreciation for $75,000, and I would have to do what? Take a loss on this of $15,000, right?
Yeah.
Right?
Yeah.
Okay. How much cash came in on that? 10. So why would, if I'm trying to get to cash provided by operations, it would be a mistake if I just simply put that $15,000 loss number. There wasn't $15,000 lost of cash that was lost. There was what? There was $10,000 of cash that came in, wasn't there?
Yeah.
So to make this show the amount of cash that came in, I go ahead and I add that loss back. I'm adjusting the net income to a cash number, right? I'm adjusting net income to a cash number, so I add that loss back. I didn't use $15,000 cash. I got $15,000 cash come in. $10,000 cash come in, didn't I?
Yeah.
So I add that loss. That adjusts my net income to cash provided by operations. And then down in the investing section, I'll show cash provided by investing activities, $10,000. Now I'm explaining that change in cash for the period, right?
Right. Yeah. And yeah.
How much cash came in?
10,000.
Do I want to get the cash, change in cash for the period? Will 15,000 get me there?
Yeah, but I don't know
Because I didn't lose $15,000 cash, I got 10,000 cash.
Okay.
So I back out the effect by adding that loss back.
Okay.
That's going to give me my cash provided by operations, and then I'm going to put the actual cash down investing activities where it belongs, right?
Okay.
Great. Dividends paid, if there could have been a question that could follow on to this, it would say how much should be shown as cash used for financing activities. The dividends will be down there, right?
Yeah.
We would subtract the dividends from the financing section because we paid the dividend, right? I mean, dividend, you always have to know to subtract it because if they call out dividends, that means you paid the dividend, right? Huh? Because I'm not in the financing section, I'm dealing with cash provided by operations. Okay? All right, let's take a look at another one. The following data is available. Cash provided by investing activities is what they want. Sale of land for $225,000. Is that going to be now the proceeds and the sale of land goes into investing, right? Paul? If I was doing this for my transaction that we were just looking at on the board, there'd be 10,000 showing here for the sale of equipment, right? Is that investing? Okay. Issuance of common stock. Sale of equipment. Here's the sale of equipment. Does that go there?
Yeah.
130,000. Purchase of common stock. Not purchase of common stock. Issuance of common stock. That's what? Financing, so we ignore that one. Purchase of equipment, we invested in equipment, so we subtract that out, don't we? Remember, we've got an investing department that's doing all this. Payment of cash dividend goes where, Grace? Financing, it's not investing, so we ignore it, right? Right? Okay, good. Let's do another one. The following data are available for two-off company. And they want the net cash provided by financing activities now. How about increase in accounts payable? Increase in accounts payable is going to be a operating, and we're going to do what? We're going to add it. We're going to add it because we must have shown an expense, but there was no cash, right? But that's not what this question is asking me, so I ignore it. Increase in bond payable. If I'm doing what? If I'm issuing bonds, my bonds are coming up. Bonds are debt, isn't it? Isn't that getting me financing? So since I've got more debt, I add that increase in bond payable, right? Right? Remember we said if you issue debt, that's financing. And since your debt went up, more cash must have come in, right? On that. So you add that back. Sale of investment, guess where that goes? Investing activities. Get the sale of investment. Issuance of common stock, is that financing? So that goes into the financing. Payment of dividends, Grace, is that financing? So that gets subtracted out, doesn't it? It's even the same number, 90,000, that we ignored before. Okay. Okay, good. Let's do another one. ADMA company reported a net loss of 6,000. So loss is a negative net income, isn't it? So I put that down to net income. During the year, accounts receivable increased 15,000. Is account receivable an asset? Account receivable an asset? If it is, you do the opposite, you subtract it. It increased, you subtract it, right? Okay. Accounts payable decreased by 12,000? Huh? Oh, I'm sorry. Inventory decreased by 12. It's an asset. I do what? I do the opposite. I add it, don't I? Okay. Then what? Then I sit here and I have my accounts payable decreased by 20. It's a liability. I go in the same direction I decreased it, I subtracted 20, right? Okay. Then I say that in depreciation expense was 12, that's everyone's favorite. You add that, don't you? And you come to the number here, this cash now what? Cash used is 17, right? Cash used is 17. Okay. Okay, good. Let's do one more. Let's do one more. Let's do this one. Wilson Company reported net income of $105,000. Where's my $105,000 net income? Oh, here it is. This one's in black here. $105,000. Okay. During the year, inventory is decreased by 15. Is inventory an asset? So I do the opposite. I add it. Okay. Accounts payable decreased by 20. Is that a liability? So I use the same direction. Since it decreased, I subtract it, right? Okay. Depreciation expense was 18. I add that. Gain on the disposal equipment, Paul, I do what? Huh? Well, if I sell an asset and I sell it for more than its book value, okay? If I sell an asset for more than its book value, I have an asset that has a original cost of $50,000, has accumulated depreciation of $30,000, therefore has a book value of what? $20,000, right? And I go ahead and I sell the thing for, what did we sell it? What did you say? The gain was $9,000? So I'm going to sell the thing for $29,000, right?
Yeah.
So I'm going to go ahead and I'm going to debit cash $29,000. I'm going to go ahead and credit the equipment for the original cost of $50,000. Debit the accumulated depreciation for $30,000, and I'm going to go ahead and credit a gain here for $9,000, right? Right? Okay. But really, $29,000 cash came in on this thing, didn't it? So to get to the correct cash number, I will do what? I will subtract the gain from cash provided by operations, and I will put the actual cash proceeds in what section? In the investing section, right? Because I sold my equipment. And I put $29,000 cash down there. Okay. So when you have gains and losses, you add the loss, you subtract the gain, because we don't want that book number. That's not the cash. I want the cash that came in, right? So I'll go ahead and I'll then do the actual proceeds down in what section? The actual proceeds is where? Investing, right? Okay. Okay, good. So now I want to go ahead and I want to do the free response question. This class gets out at 9 o'clock, right? Huh?
So you said that 9,000 loss goes into your operating, what you add, and then the cash of...
No, the gain subtracts.
Oh, sorry.
The gain increased my net income, so I subtract it.
And then for the investing, you add the 29,000 cash.
Actual proceeds cash, right?
So that becomes 20,000, right?
No, it becomes 29,000. My net income showed 9,000, didn't it? Did my net income show 9,000?
Oh, yeah.
My net income showed 9,000. The fact that net income showed 9,000, but there's no cash. I'm trying to get to cash provided by operations, right? If that was the only transaction, my cash provided by operations, there will be zero. And then down in the investing section, now investors can see this dude didn't generate a $29,000 increase in cash because he's a genius and he had net income. This guy sold the equipment of the company. Is he going to be able to sustain that very long? No. And so you could tell that by saying that that cash was not provided by operations. If this was my only transaction, after I make that adjustment of subtracting the gain, my cash provided by operations is 0, isn't it? But my cash from investing activities is $29,000. It'll say on there sale of equipment. And if my cash was 0 at the beginning of the year and $29,000 at the end, you're like, well, he generated all his cash from the sale of his equipment, right? And you would be able to tell that. Okay, and you come over. That's net income plus adjusted for the current items. Assets use the opposite direction. Liabilities use the same direction.
What does that mean, like cash provided by operations? Like,
That's how much cash came in from my day-to-day operations,
okay.
which is analyzing the current items, taking losses and gains, adding the losses, subtracting the gains, amortization, which is going to get me to a true cash number is for my interest expense, right? And then my my depreciation. Depreciation is part of my operations. Okay, now let's come over and let's take a look at, where'd you go? Oh, okay, thank you. Okay, so I go ahead here and I give you the balance sheet, and then I give you some more information, and then you are to prepare a statement of cash flows. Okay? Now, you come in, and in here I tell you the net income is how much? Is the net income $40,000? Okay, see, net income is $40,000. So the first thing I put for my cash flows from operating activities, I put $40,000 net income, don't I?
Yeah.
Okay, then what? Then I'm supposed to remember CLAD, current items, losses and gains. I'm going to add the losses. I'm going to subtract the gains, amortization, and what? Depreciation, right? Okay, so let's see. Do they give me depreciation expense here? No, but they tell me that what? My accumulated depreciation went from $10,000 to $14,000, didn't it? So don't you increase your accumulated depreciation by the amount of your depreciation expense? And so I go ahead and I do what? I add back the depreciation, right? Okay, then what? Then I have decrease in my accounts receivable. Did my accounts receivable decrease? Yes, it did. If the accounts receivable decreased, it's an asset, so I'm going to do what? Use the opposite direction. I'm going to add it, right? Right? Okay. Okay, good. Increase in inventory. It's an asset, so I subtract. I'm not going to keep going up there to prove that the numbers are right. Okay, so I decrease it. Increase in prepaid, since it's a what? Since it's an asset and increased, I subtract it. Opposite direction, right? And again, I'm doing this because what? Think about it. If I have an increase in prepaid insurance, I used up cash, but there was no expense associated with that, right? So what do? I'm going to sit there and I'm going to subtract that from my net income to get this number, cash provided by operations. It works the same way with all the assets, the way we talked about with receivable. The liabilities, what? I have my accounts payable decrease. Since my accounts payable decrease, I paid a bill this period that what? The expense was taken last period, wasn't it? So that decreased last year's net income. It's not going to decrease this year's net income, but it did decrease my cash, didn't it? To pay off that liability. So since that decreased my cash, I go ahead and I do what? I subtract that because the thing decreased. Same direction, right? Same direction. Does that give me cash provided by operating activities?
Yeah.
Okay. Then what? Then I go ahead and I get into my investing, and let's see how we would have figured that out from this problem. Notice that my equipment did what? My equipment, where's my equipment here? Property, plant, and equipment went up $10,000, didn't it? So did I buy equipment? Did I buy equipment?
Yeah.
So that goes into the investing activity. That's a use of cash, right? And then financing, cash flows from issuing stock. Did my common stock go up? Common stock went up 20,000, right? So I know that's a use, a source of cash down here in my financing. Cash flows from the payment of bond payable. How do I know I paid bond payable? Well, my long-term liability came down 30,000, right? Okay. Then what? Then they tell me if I look at this other information, no property, plant, equipment was disposed of. I need to know that so I know that that change in equipment is purely what? The purchase of the equipment, right? Okay. And Texas paid $16,000 in cash dividends. Where do you want that to go, Grace? Financing. It's going to be a use of cash of $16,000. Is that the use?
Yeah.
Okay. And we have the net increase in cash. You add the beginning balance. That gives you the ending balance, right? Okay. So again, guys, the logic is contained in those 2 years worth of information that we looked at. When we had the receivable and we had a sale, but we hadn't increased our cash, our receivable went up, so we subtracted it, right? Our accounts payable did what? Our accounts payable went up. We had an expense, but we hadn't used cash. Accounts payable went up, so we added it, right? In the next year, what happened? Next year, we had a situation where our receivable went down, but there was no income generated, so we did what? We added it. Our accounts payable came down, meaning that we used cash, but there was no expense, so we subtracted it, right? The logic is contained in that little example, but you can always remember by remembering current items. You use what? You use the current items. If it's an asset, you use the opposite direction. If it's a liability, you use the same direction. That was it 100% of the time for these, wasn't it? Okay. L, losses and gains. Losses, you're going to do what? Add the loss, subtract the gain, right? Amortization, if it's an amortization of a discount, you're going to do what? You're going to add it. Good. If it's amortization of a premium, you're going to subtract it. And then we had depreciation, which is a piece of cake. You simply do what? You simply add that. Okay? We then have what? Our investing and financing. Investing is our investing department that sits there and does what? Makes investments, buys property, plant, and equipment, also buys stock of other companies, and does what? Buys bonds of other companies. Financing was our financing department in which we attract capital to the company. How do we attract capital to the company? By issuing our own stock, by issuing our own bonds, right? And then you will have to pay, of course, dividends on those bonds, Grace. So the dividends go into financing, right? I think Paul was first and was George.
So buying bonds and buying stock would be you're investing, but issuing stock and issuing bonds.
That's correct. If you buy bonds and you buy stock in other companies, you're investing in that company. If you issue your own stock and your own bonds, you're acquiring financing, aren't you? Okay.
Could you just scroll down to the saving calculation?
Yeah. Okay, what am I, a computer jockey here? Do you have a question on that?
No, I was thinking on my way.
Okay. Question.
Are the inflows and outflows necessary to write when the cash business financial investing? Like, do you need to write like the forward outflow or inflow?
Yes, you need to show, you should show cash flow, inflow from operating, from cash outflow to purchase equipment, cash inflow from issuing stock. I know that the plus and minus would make it what you're thinking, but I think you should call it out. Yeah.
And also, losses and gains always go into operating.
Losses and gains, the actual accounting loss and gain are part of our cash flow from operating activities. That's correct.
So then, given the ending cash balance, so we just always so we can see where, I guess.
Yeah, because if you look, look, we know that cash change. Come on, guys, hang on a minute now. This isn't wrap-up time. You got a test on this stuff day after tomorrow. We know that cash changed what? Cash changed 2,000, right? And what this is showing you, Samantha, is, okay, why did it change? Okay, pretty good. This guy generated 38,000 from operating activity, paying off accounts receivable, paying off accounts payable, having a little depreciation, etc., right? Then what? They really used up cash from from non-operating items here, the purchase of equipment and financing activities and paying amounts back in dividends and stuff. And so if I'm looking at this company, I'm thinking, okay, that's not too bad, because their operating activities, the number one source of wealth for a person, for a company, is not issuing stock and not borrowing money, is what? Generating money for income, right? And if this trend continues, this should be a pretty healthy company.
So then is this similar to the final, or is it like the last one, like after you like pull this out, so
You are to know everything that we've studied, and you are to be able to answer it in the form of a multiple choice question or in the form of a free response question. And the things that were in that free response question, I taught you from last time. So I'm not obligated to give you a free response question. I don't even have to give you a practice one, to be honest with you, but I do. So you may get a full a free response question in which I'm asking you to amortize a bond. I am choosing the free response format to reinforce the statement of cash flows for you. This does not mean that you're going to get a statement of cash flows free response. Huh?
this will all be a surprise.
Yes, they're all surprises. And the first exam, I gave you one that was exactly like
Yeah.
the one that I gave you. Huh?
The last one you told us.
Oh, did I?
Yeah. You gave us a different tax one. Yeah. That was really bad.
And why did you say it was completely different? Oh, so you're saying, well, I see. Do you want the statement of cash flows free response?
Yeah. The bond. Yeah. Over the bond, absolutely.
Okay, well, I'm not going to give you this exact one. I'll tell you what. It'll either be, let's do this. Let's compromise. It'll either be this or the bonds. Okay, hang on, guys. Time out. Wait. Let me say a couple things, because we're not going to have much time left. Okay, so look. First off, are there any questions on the statement of cash flows thing? Look, I understand that it is hard to understand statement of cash flows in an hour and 15 minutes, especially if you've never had it before. What I tried to do was fit it into that amount of time by giving you those ways to remember. And I'm just going to tell you right now, I've had CPA students knock the ball out of the park just doing what I just told you. They've gotten full statement of cash flow problems with the CPA exam, and they know that if they deal with current items, right, opposite direction for assets, same direction for liabilities, losses and gain, add the loss, subtract the gain, amortization, I'm not going to go through that again, and then what? Depreciation is a piece of cake. You just add it back. That's going to get you points, and I'm going to be giving credit for if I put it on there, for the areas that if you get cash provided by operating activities correct, I will give you the points for that. Okay, but if you mess up somewhere in here and you got one or two wrong, I guess I'll have to give you partial credit for that, right? Okay. If you mess up in here, you don't put something in here, I'll have to give that you shouldn't. I'll take points off. If you put them all in there, I'll give you the full points. Okay. You probably won't get any points for the ending cash balance, because that's going to probably be given to you on the problem, right? Okay. You'll get some points for if you get the full points. If you get the change in cash, no, because you'll know the change in cash. So I probably won't give you points for that, huh?
You need to remember the credit though.
That's true. That's true. Okay, well, I'll think about that. Jordy?
For the bonds, do you know both the straight line and the...
Absolutely. just like it is in your homework problem. And there's that one big one where I give you the effective, and then there's the other file that had a bunch of straight line ones. Yeah, sure. Hang on, guys. These guys are probably asking questions that might help you.
Is the effective like when you basically amortize it each time? Kind of?
We amortize it each time, but the process is you take the carrying value, the new carrying value of the bond, you multiply it by the market rate of interest. That gives you the interest expense. You then compare the interest expense to cash interest. That's going to be your discount or premium amortization. And if it's a premium amortization, you subtract that from the cash interest to get the interest expense. If it's a discount amortization, you add that difference to the cash interest.
So, okay, so you basically apply the interest rate to the. Okay,
Yeah, then that will bring your carrying value. If it's a premium bond, the carrying value will come down. If it's a discount bond, the premium value will come up by the amount of discount or premium amortization, right? Gives you the new carrying value times the market rate of interest and so on. Question? Question? Okay, guys, my strong advice is that you look at the rest of the Chapter 12 quiz that we didn't go through. I would hit that sooner rather than later while you're still remembering this. Go through the Chapter 12 quiz, and then you should go through Chapter 11, since that stuff was a little easier, the Chapter 11 material, and then you should be sort of going through everything after that so that you are ready for the exam on Wednesday. Bring your Scantron. Bring your Scantron. How many questions did we agree on? 25. 25? You want 25 or you want 30? 25. 25? Okay, we'll do 25 questions in a full-blown problem. Ray?
No taxes, right?
Huh?
No payable. Chapter 9.
Notes payable.
Yeah, no, we're going to have it. No payable. No taxes. No. No payables, yes, but no taxes. Not the payroll.
And that was the whole quiz with the tax.
Yeah, I know, except the last two questions.
Okay.
And if you look at the practice midterm that I just put up, there's some new ones in there.
Thanks.
Yeah. That are notes payable, not taxes. Okay, guys, have a good night.
Wednesday.
Bye-bye. Have a good night. Okay, see you Wednesday. Bye. Okay, have a good night.
See you on Wednesday.
See you.
I just have a total of 2 questions.
Sure. Hang on. Let me stop this.